In the constantly changing world of fundability, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. Welcome to the Get Fundable podcast with your host, Merrill Chandler.
All right, good sir. David Smith, back at FICO World. This is where I get to come and play, where I always use this example that FICO World is the Mount Olympus of the credit and funding gods.
I think you're giving us a little too much credit.
Because even though approvals themselves do not rely on the FICO score, the threshold, the denial threshold of whether or not somebody's even considered is FICO score based, right?
And we're more than FICO score. We're very much into the decisioning, and a lot of the organizations that you apply to are using our technologies. And so, yeah, we're kind of involved. It's in the background. It's about everything.
No, you are the background, just like we have FICO World 23 in the background. So we've had, you're catching up with us. This is the Fundability podcast, live streaming now as well on Facebook to our Fundability Hackers group. But one of the things that we wanted to discuss were some of the highlights of our conversation yesterday, and more importantly, the trends, where we see things going over the next year. We're a full year into SBSS score, the Small Business Scoring Service. At 7.0, everybody adopted it, right?
Yep.
And we have some significant movement in the SBA, et cetera. And by the way, he's likely not to mention this himself, but David actually is the individual who leads the team that every year goes to the SBA and reviews their portfolio, because they all use the SBSS for reporting how well the SBA lending portfolio is, gives it a grade, and then the SBA goes to Congress and says, guess what? Here's our grade, right? This guy is the lead in that group.
I do the presentation. It's not where people do the math.
Yeah, but you're the show. You're the show pony, right? You're the one giving them.
I'm sadly, I'm the pretty face.
Well,
oh yes.
I just want all you guys to know that they didn't just hand over some PR guy to us. This is the guy in the business space. You definitely do the work, and our friendship, we've been to since 7 years. FICO, 6 years. You and I, because we got introduced on 2018.
Since.
We've really having a blast. All right. So for those of you who he was miming to some of you, and because we're sensitive to all, populations, the lip readers out there had a chance to catch up and get grounded on how to read his lips. So now that you guys are caught up, we're going to go live with audio.
Audio is important these days, I take it. So
thank you. And this episode is produced by Jessica Tabora.
Hey, idiots.
Hey, idiots.
They can't hear you. So SBA changes.
Yeah.
SBA changes. So first of all, the 7A Express program, which utilizes the SBSS score, is being upped from dollar value from $350,000 to $500,000. So $500,000.
That's a 40% increase.
Yes. No, it's not insignificant, and a lot of study was done behind it. We actually talked about that a little bit before COVID hit, and they're putting those changes in now. So
Brilliant.
It's really good for everybody. There's also a new DEI outreach. Start looking out for that.
Tell them what DEI is.
So basically, if you're a minority-owned business, female-owned business, if you're in an enterprise zone, if you're working with a CDFI or community development financial institution, there's going to be more money for you soon. So if you qualify for that, please start asking around, start looking at the website.
Yeah, check in on Get Fundable, et cetera.
And you're going to get better terms for those loans. By the way, another trend right now, especially as interest rates are rising, ask your institution whether you can get an SBA loan, whether you're eligible, because those are longer term loans at lower interest rates.
Amortized 15 or 30 years,
Yeah,
even though the payout is over 10 years, the amortization is over 30.
Huge savings if you can get it. So try to get an SBA qualified loan. You're going to benefit from it. So
Brilliant.
It's a little more paperwork. I'll fully agree, but
it's ultimate in manual underwriting, right? And that's how our universe talks. Is it automatic underwriting or manual?
Yeah,
right?
Manual. It's more paperwork, more manual underwriting. But again, from an investment of time, well worth time spent, right?
Brilliant.
And then there's a CFPB change that's coming down the pike that'll hit in about 2 years for most organizations. And that you'll hear it called the 1071 rule or the 1071 report, which basically in current mortgages, there's a thing called HMDA, HMDA, the housing mortgage, something. Everybody knows it as HMDA. Don't ask me what it stands for.
Doesn't matter what it stands for.
It's like, what's the profile of the borrower? They want to know gender, age,
identity information, financial information, banking relationship.
Yeah. The key thing to know about this, though, before people, get their feathers in a ruffle, is there is a firewall between that data and the loan application itself.
So there's no bias.
Yeah. This aspect of the bank is collecting this data and it's going into this section, whereas the application goes into here. And the institutions, if they can't create that firewall electronically or manually, they have to notify you that, hey, the person underwriting your loan will see this information. Right. So you'll know up front whether a firewall exists.
And you can choose the institution accordingly so that you can be a choice as to whether or not somebody sees your profile information versus your financial application information.
Yeah. And again, this isn't a today thing. Banks have, I think, 18 to 24 months
to implement
into place. They're going to start testing this in about 12 months. So you're going to see the larger institutions test this on day one.
All over tier ones and top tier twos.
Ones and tier twos, where your community banks, your 3s and 4 tier banks are going to implement this probably at the last second that they can.
Well, like they always do.
It's a lot of work. It's a lot of technology. There's going to be cost involved. So all their technology partners are coming up with solutions right now. We're all talking to the CFPB. We're all talking to our compliance folks. But it's just a really interesting rule, and we're going to see how it shakes out. So.
Yeah. What do you think is the intent behind it? I mean, I have my ideas, but the intent behind it, because this is ubiquitous. Every financial institution has to ultimately implement it.
And so the intent is to find out, basically, is there disparate impact? That's the first thing. Are banks treating certain customers differently than other customers? And that's always, you always want to find out, is everybody being treated?
The redlining, but all the old school ways to create bias.
So, have we hidden this in small business? Because small business lending has just been sort of protected from that previously. It's not consumer lending, even though consumer data is being involved.
Right.
And that's the position the CFPB is taking. You're using consumer data, so therefore
we want to know
what people you're dealing with, because you're using people data, not company data, right?
And as I understand it, even though there's a firewall, what they're doing is aggregating this data, the borrower profile data and the financial data, and seeing if there's there should be or it's designed to create a correlation in fundings evenly across the board by financial criteria only, not profiled.
Correct.
Right?
And that all should be treated equal. And that's a nice thing. I'm not saying it shouldn't. I'm just saying it's hard to treat everybody equal when you don't know and can't ask. You're
right.
They did this study where orchestras did this test where they put a blanket in front of the person playing so they could just choose the better musician. Right. So they're not choosing based off gender or age. Or
right.
color.
It's whoever has the most talent, skill.
And that's sort of what we're trying to get to. Right. That's the perfect world here. Right. Who's credit worthy? Who's fundable? As opposed to who's the kind of person I want to fund.
Right.
It's just not right.
And it's so disadvantageous because you're excluding potentially very conscientious borrowers, highly fundable borrowers, based on irrelevant decisioning like race or creed or location or otherwise.
And I can show you the SBA data with a FOIA request, but I can show you the SBA data.
This PSA brought to you by FICO.
But when you strip everything out, because the SBA's charter is to go into lending areas that banks
don't service,
that typically, quote unquote, are profitable, right? But it turns out they're very profitable.
Okay, and this what I want to key off this. So keep this in mind. In our discussion yesterday, David made a critical point, saying that most people, it isn't necessarily unbanked, because unbanked means you don't have a checking account, savings account, or otherwise. It's underserved populations who pay cell phones, pay their utilities, pay their rents, as though their lives depend on it. But we're barely, FICO XD is barely starting to collect all this data. Yeah. And that data, it is payment mentality, borrower behavior. It almost doesn't matter what you're paying, right?
The FICO score is a psychology score.
Yes.
Not a bank account score. It doesn't say how much money do I have in the bank. It's how much are you willing to pay your bill, And in some cases, I'm going to pay my debt because it's a debt and I have to serve that debt before I do other things like go to the movies,
It is a psychology score.
Buy new shoes or whatever, because I owe this debt. I'm going to pay it. It's very much a psychology score.
Yeah. And that, I just wanted to bring that up from our conversation yesterday, that the intent to pay is a fundamental borrower experience rather than, I want to live in my house. Well, people who are paying apartment rents want to live in their house, but pay their car, pay their cell phone.
And in fact, the apartment, the mortgage company will let you go 90 days before they tell you they're going to kick you out. The apartment complex, 3 days, their stuff out on the street on day 6, right?
Yeah. 3 days to evict, right?
It's gone.
Yeah.
There's more of an urgency to pay that stuff. And that's what I don't get. The telephone company is going to shut you off. Your ISP is going to shut your internet down.
Yeah.
Whereas the car company is not going to come get your car until 3 months later. Why are we
prioritizing?
Right?
Prioritizing. And FICO XD is a whole different score that's
integrates all that data.
Integrates that data. And they're able to, and FICO not only is helping lenders collect it and report it to the lenders for decisioning purposes, but interestingly enough, that is the lead in to creating a real FICO. I don't want to say a real FICO score, a credit system FICO score.
Oh, and we're moving to this ecosystem of data availability, right?
Right.
The internet's a glorious thing like this. Data lakes and data becoming ubiquitous.
Yeah.
Trade information that shares. The telecom companies, they all keep a database because they associate together, and they've agreed to put this data in a system that they own.
You're right.
And now they're like, well, that might benefit others. Let's go ahead and try to start sharing it. So we're starting to see leakages out of those data lakes, which is going to feed tributaries into smaller ponds, if you want to follow that analogy.
I love it.
So that everybody gets to enjoy the waters that they've...
Yeah, the new data streams that are available are going to help us in better and better decisioning. Yeah. And therefore, underserved stop being underserved because there are institutions will be able to track...
access that,
all of their things. Now,
so in the meantime, by the way, if you are in that underserved category, keep paying your bills. Don't bounce checks.
Yeah.
Start pay stuff on time, but also try to get some sort of subprime. I hate using the term.
Yeah.
Credit card. Get some credit facility that is reported to the bureaus.
Yeah.
You can start building that score, and that's usually younger people new to the country.
Yeah.
That sort of thing. I highly encourage it, and if you have it from the intent of treating it well, right?
Yeah.
If you have it from a need perspective, don't get it because you're going to max it out and not pay it.
Yeah. And interestingly enough, our strategy we teach, rather than go for a lower tier credit card, we go for use that same money that would be used for secured purposes or otherwise, put it into a checking account, drive a checking account traffic to build a relationship with that bank, and then get a $500 and start building with the bank and then raise limit.
Yeah. That's fair.
And we get to do tier 1 and tier 2, and they're aggressive. Some of these $350 rebates on Wells Fargo just for opening up a checking account, right?
Yeah, and there's also new deposit loans that are available.
Yes.
It used to, they would offer you an overdraft protection product, and now that's being turned into a small dollar loan product, which is helping abate I'm losing my paycheck loan companies.
Yeah, we want to get
away
mainstream banks using the paycheck loan but now you're using it as a deposit,
right?
And then you're borrowing against it inside of your own checking account, building a banking relationship, which is critical. The first step in building relationships towards everything that we want from a bank and how to partner with them.
Yeah. So back to 1071, which led to all this. 1071 it's reporting. The purpose is to, again, find out who these small business owners are, who's borrowing, how are the banks treating these people and that term is called disparate impact. Is one group being impacted differently than another group? And we're going to see some positive outcomes of this and some negative outcomes of this, but in the grand scheme of things, I think it's all going to be positive because I think you're going to start seeing organizations change their ways now.
That
knowing that the spotlight is coming.
Yeah, that's
what
I see.
You want to put on your best outfit for that spotlight.
The good old boy banks have to evolve, or you're going to find that lack of firewall. Everybody's going to say, "Oh, I don't want to bank with you anymore."
I cannot name names, but there's also a new whistleblower law being put into effect with a ruling by the CFPB, which says if you're a bank employee or somebody related to the bank in any way, and you turn the bank in for problematic,
intentional malfeasance,
you can get a piece of the fine. And there have been many meetings I've been in where I'm I can make more money off the whistleblower than the deal I'm making with the bank.
New business opportunity. Start being employed by banks looking for bias.
It's I can't name names, but they're there.
They're there.
People are people, right? People don't change when they go to work.
That's why we count on the next generation to be able to start optimizing bank behavior to be more open and inclusive, right?
And when it's more transparent, it's better for everybody. So now the effect of 1071, I think, is going to be the downstream effect is currently, you could be sitting on what you think is a small business credit card from one of the big banks. And if you go look at your Experian business report or your Dun & Bradstreet report, you're not going to find it anywhere.
Right.
Because that's over on the retail side of the bank, the consumer side of the bank. And it's not being reported as a business loan. So when you go get a business loan, you can say, well, I've got this business
credit card, Spark.
And they're like, we
Discover
don't
IT. Exactly.
Having a business loan at all, a business card at all. And so the bank's not going to lend to you because you've never had a product like that, meaning small business loan, business loan. So I think this is just I've got on my prediction hat here that the 1071 is going to lead to a change in how banks report data to the bureaus. And when it's a small business loan, it must be reported.
They're going to update their process to report to business bureaus so that they're almost because there is no FCRA for business credit reporting, right? But now there's
a crack in the dam.
Yeah.
The crack in the dam is going to regulate the business, the small business reporting.
Yeah.
And it's going to lead, because again, when I submit that 1071 entry, I'm now saying I am a small business owner and I have a small business product. Do you? Do you really? And I think you're going to see.
And if it's not showing.
No, and I think a lot of banks are going to be going, well, this isn't a small business product. This is a
retail product
with marketed to small business owners.
Yeah, that's what we call an imposter business credit card.
This product isn't eligible for this because it's not I think they're going to weasel out of it tremendously. And again, that bright light is going to be shown. Are you getting a small business loan or are you getting a personal?
Personal. Yeah.
And
Elon Financial, I will name names. Yeah. Elon Financial is notorious. He can't, right? I don't even know if Elon is a customer, but Elon Financial underwrites gobs and gobs and gobs of a credit union, tier 3 banks and institutions, community banks, because they don't have the in-house underwriting to do it. So they name it. But Elon reports everything to personal, everything. And so we have to train our tribe to go vet a bank to see who underwrites the card and do they report to personal.
No, it matters because that's, it can end up really killing your personal score.
Yeah.
If your utilization is high, if your exposure rate's high, if your balance rate's high,
absolutely.
It really can kill it. So that's sort of, what's happening.
1071 is on its way.
Some other stuff that I'm just kind of learning about, but lots of changes going on in the space.
I'm loving it. So one of the things that we talked about yesterday was the shape or FICO's movement. I learned so much this week about the platform versus the independent software components. Will you speak to that evolution over the last couple of years and what it's become?
So we used to sell products, right? We used to
67 of them,
something like that.
67 products.
Yeah. So I sold a product called Origination Manager, which was the product that certain companies use to originate consumer loans, small business loans, deposit accounts, that sort of thing. So you would go in and as you're feeding your information into their application, that application's feeding into our decisioning engine. That decision engine then is being affected by a workflow engine, which is telling the data orchestration system,
the insight side,
to go get bureau data, to go get internal data, to go get this and that, to complete your data profile. And then we just churn that, decision it, run it through a big, if you want to think about it, an if-then statement, or visually, it's a big Plinko board from The Price is Right. You start here, you end up somewhere on the bottom as an outcome. And so we had one of those products for originations, collections, fraud, customer management, blah, 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 blah. Name the silo in the bank. And then we just determined one day, we're really good at making decisions. We don't care what the decision is. When you ask us a question, we're going to give you an answer. When you want us to go get data, we're going to go get data. Our FICO Data Orchestrator reaches out to 150 something different
databases
across
150 plus
across the globe. I mean, what do we have in Denmark? I can tell you, right? What do we have in Iceland? Literally, we have something for you, right? So this is the reach that we're doing, and it's all organic. Customers are going, hey, we need data from this system. Okay, we'll build you a connection, because they're making decisions about things, and it's things that you wouldn't think about. We have a video. If you go to FICO.com or the YouTube channel, I don't know where it's put. I really don't. I'm terrible at marketing. But you can watch a video on how we help companies detect fraud. And one of the things we check is how quickly did you tap through the app? How quickly are you moving from page to page? Because that means panic, or that means haste. That doesn't mean thought, right?
Yeah, sometimes it's not a thoughtful application.
I'm doing this quick for a reason, and 9 times out of 10, that's not good.
Right. So take a message, fill out your application deliberately. Yeah, carefully.
No, I'm dead serious.
No, thanks. New intel, new tutorial coming out live right now.
Your banks are measuring. It's not just FICO. Our system can do it, but it's other organizations with other platforms are doing this sort of stuff. It's where you're doing it from. Are you doing it from the Starbucks? Are you doing it from your house? Are you doing it from Nigeria?
That's IP address, right?
IP address is important. The system that you're using. Are you using your phone? Are you using a laptop, a desktop? What ISP are you accessing?
Yeah, plugged in Ethernet or Wi-Fi.
Are you on VPN or not? They know this stuff.
And
right?
that is way big red flag.
No, it really is. So all of this stuff, we're ingesting all of this to determine
I love this
why we're doing this, how we're doing this. And then it tells them what to think of you as a customer. And really, in a lot of cases, it's more how to protect you, and ultimately it's protecting the bank, but it's protecting the consumer so they maintain their reputation. So if you've ever gotten, I'm going to tell a personal story.
Go for it. Because
my partner Lisa was in Chicago, and I get this phone call, and she's just screaming at me, your system's doing this. Your system's doing this. Basically, she had not told her credit card company that she was traveling that week, and it was throwing fraud flags. She's at this hotel in Chicago, pretty pricey hotel, kind of outside of her norm, right? It's not the average Marriott. I think it was like the Drake or something like that.
And they totally pinged her, man. Yes.
Right? And I'm getting screamed at because their security, and I'm like, you're the one who didn't notify your bank, right? That's why you go put in, hey, I'm going to be traveling to these cities or these countries. And it kind of allows for a little more freedom in that aspect.
Absolutely.
You're not
automatically consciously using your credit. Our borrower behaviors are not rote or automatic. They're deliberate, you guys.
And you have a profile at the bank. Know this. You have an action profile,
These are places commonly visited.
Yeah. I got a text once, hey, did you buy $300 worth of liquor in a New Jersey liquor store? Not New Jersey.
Yeah.
Not New Jersey.
You caught me. Damn it.
Yeah. But, it's like, wait a second. That was at 3:00 in the afternoon. At 1:00, you knew I was at a Starbucks in Atlanta. Why did you think I flew to New Jersey to buy liquor? So, yeah, it's flagging this stuff going, wait, this is out of the profile. This is out of the profile. Do you want to authorize this or not? So there's a little bit of that, a little bit of protecting them, a lot of protecting you, a lot of protecting reputation in general, because lost money creates more expensive stuff.
Yeah,
right?
absolutely.
Bank's going to charge you somehow for that lost $5.
So let's save everybody the hassle, right? So also, true story, my girlfriend, I teach her that there are certain applications, fintechs, different platforms, look at how low your battery goes on your phone, right? And that they measure under 20%, whatever it is, that it says, it's kind of like you're now in credit risk territory, right? Because if you're not attentive to such an important communication device, how are you going to do out of sight, out of mind things? Well, so now every single time I go, hey, babe, what's your charge? She goes, I have bad credit. Every single time, if she's under 20%, she literally answers, I have bad credit. She's like, I have bad credit. And I'm like, plug your phone in.
So we did a study 10 years ago, and this is telling you how far back we've been doing this or helping our customers do this analysis is probably a better way to put it, is a particular Canadian company could tell when you use their in-house gas card for gas, when you used it close to the 15th of the month and close to the 30th of the month, that means you ran out of money, that you didn't have cash in your bank account.
Oh, see?
It's close to payday, right?
And you're using credit instead
of cash.
Yeah.
And so if you steadily use the credit card throughout the month,
no harm, no foul.
You're probably transacting, you're probably using it, then paying it off, right? But if you only use it on the 15th and only use it on the 29th, you're a credit risk because you have no money in your bank account.
Guys, see how cool this is. See how much intel that we can deliberately plan. And the app we're building is actually designed to account for many of the and give reminders about how to use credit intelligently throughout the entire month, so that we're avoiding these red flags.
Yeah, and I was talking to a South African bank this morning, and American banks do this too, not just South African banks, but he's talking about how he looks at average checking account, DDA balance, average balance, current balance, minimum balance, maximum balance, and the ratios between those. And he's like, yeah, we track
time into one of those strata.
Yeah. What's the distance time-wise between average balance and minimum balance? Right?
3 days or 3 weeks, right?
Because there's some accounts that I'll keep an average of $500. Okay, it's $1,000 or it's $0 because I pay bills out of that account, right? So I'll put money for the bill, and then 2 days later, it's gone, right? So I'm a bad person on that one. But my checking account stays within a range. It's comfortable. Everybody kind of anticipates it. Occasionally, you'll get a big deposit. Occasionally, you'll get a big ACH going out.
So that's why we do 1, 2, 4, 7, everybody. Minimum balances through the month, whatever it is. And then we transact it. We call it the new zero, right? We want the new zero to be about 1,000, 2,000, 4,000, 7,000 or higher. And that way people can then play the zero game at.
I'm telling my daughter, it's kind of like when you tell a new driver, don't let the gas tank get below a quarter tank.
Right.
Catherine, don't let your checking account get below $25. She's 21. She's in college. This is $25 is a ton to ask for her to do. Like you can't, you need that special fund. You need $5 worth of gas to get home or whatever. You need $5 for an Uber, whatever. You need it. So keep the reserve. Consider $25 zero. Consider a quarter tank of gas.
That's exactly
zero, right?
The new zero.
At that point. Yeah. I'll start using your phrase, new zero.
Yeah, and we want it to be $25, but we want to start hitting those minimum daily balance DDAs because 100, 200, 400, 700 those traffic patterns mean something.
No, they really do. They really do. They
in the banks, right?
Because again, cash flow is the new thing.
Yeah.
Right?
Update us on that. Update us on what's coming down the pike about not
NDAs, Merrill. NDAs.
Oh, sorry.
No, I'm kidding. I'm kidding.
Like, oops,
no,
I keep crossing the line.
This is some secret sauce. Tell them about the secret sauce.
We're like, just what color it is, not how it tastes.
It's always managed to catch up with a little bit of relish, right?
Yeah.
No,
true.
So what organizations have been doing is looking to see how effective cash flow is in helping predict credit or helping predict repayment, not really credit, but repayment of loans. And so you have the initial credit discussion of, is this person worthy? Are they fundable, right? Then the second question to ask is, can they repay this? Do they have the actual means to repay this?
Which is always a cash flow issue, not a credit issue.
Always a cash flow issue. Because what you don't want is to use credit to pay for credit, right? You want cash to pay for credit.
That's the bottomless pit.
And no, it really is. And so just another thing I've learned, I'm going to sidetrack here. We track as a company, percent of minimum payment and then percent of payment compared to balance and compared to max. And those numbers are creeping up these days.
Did you hear that? Tracking how many times you make a minimum payment, because that's another statement of lack of funds.
If your minimum payment's $35, pay $38. I just get off you're still not going to be high, but pay $1 over the minimum so you're not minimum payment marked.
Yeah.
There's another mark. There's another code for that above, right? Is paying more than minimum. And
it almost doesn't matter how much other than the percentage of the balance.
There's another value. There's another characteristic that will measure that.
Yeah.
But at least on this aspect, you're going to be scored higher than just paying the minimum. So again, if it's 30,
paid other than minimum.
Yeah. Try to pay 40, try to be higher than that. Anyway, that's
brilliant.
Yeah. Brilliant. But more and more people these days are using credit cards for cash replacement, and you're starting to see more and more people put utilities on credit cards. They're paying their gas bill, they're paying their electric bill, they're paying their water bill using credit instead of cash. And because any of y'all gone in a grocery store lately, you can't buy a dozen eggs for less than $3 these days. That used to be the cheapest meal out there. No more, right? Yeah. I grew up on eggs on Friday because we don't have any money.
No.
The cheapest meal.
See, so, the powerful thing with that, and what we train on, guys, is if we train the algorithm. Remember, two things can exist at the same time. You could pay your utilities on a credit card if at the end of the week, as we instruct, in the end of the week or biweekly, we're paying it off, right? We're paying it to 1%. We're paying it to 0. Because we want those things, we want the points, We want the traffic. We want to, we don't want them lowering our limits because of lack of activity. So we charge up everything we can. But if you hold balances and you're paying utilities, you're only painting half of the picture. We need to show the pay downs on the regular basis.
And I'm not saying don't pay your utilities with your credit card.
But if it's the only thing,
if you're not,
it's an indicator and red flag if you do not have the corresponding payments as well.
you should immediately pay your water bill with your credit card to get some miles or points or cash back or whatever. But then open the next browser tab you open is your credit card company
And pay it off.
Right?
Yeah.
I can't tell you how many times I do that. But if you're not going to take step 1 and step 2,
Do not do
step 1.
Do not do step 1. Great
Skip
point.
straight to step 2 and pay your water bill with your cash.
Yeah. Brilliant.
Yeah. So that's,
That's a lot.
that's about it. Yeah. Cash flow it matters. Velocity matters.
Yeah.
That single account.
Checking account.
Yeah. So let's talk about that. The
Yeah.
single DDA account, checking account, demand deposit account is what
Yeah.
we use.
DDA stands for demand deposit account.
And so
Checking.
So, but nobody uses checks anymore. So I think
DDA is
the kid's like, what's a check?
like
That.
check.
You write things down
On paper. That went out with the 80s, Dad.
So,
Where we come from, man, and where we're going.
different world, man.
Yeah.
So DDA accounts have one singular DDA account at one bank that everything goes into. If you can, I understand there's certain times there are partnerships and blah, blah, blah. But if you can funnel everything through one account, because
and then move your expenses or otherwise after that.
around that, because again, I have one account where all my money goes into personally. And then I've got my bills account. I've got my daughter's checking, my daughter's college fund account. I got this, and I just move money at the,
After it's deposited into a singular account. That's what we teach is choose an account to be as your main account, because that's where all of the traffic indicators, all of the internal performance data is going to be tracked. We want to maximize those.
So the systems out there, they're called Plaid, PLAID, Yodely,
MX,
MX is another one, yeah. And what they do is they go in, you give them your logon for the bank, and they go in and they interrogate that account. And if you're putting some of your money here, some of your money there, the bank that's looking to fund you doesn't have a complete picture of your cash flow. Now,
You heard it here.
yeah, I mean, Meredith's been saying this for how long? Right? It makes sense. And that's what these systems do. And that's what the banks are doing now. And they'll count, okay, you had $10,000 go out of this account via ACH. We're not tracking where it went. We're not tracking what it is, but they can see, hey, I've got every 14th and 29th or 28th, whatever the end of the month is, I see ACH is going in, going out. Okay, that's payroll, right? That might be you pay yourself or you're paying your employees. They deduce this via the data, right? And Yodely and Plaid and MX will tag it as payroll going out to another account, blah, blah, blah. And they'll track how you're spending, what you're spending out of that account. So if you're swiping a debit card at, Starbucks, they're going to know, hey, this person spends out of this business account, they're spending $75 a month at food places or whatever, right? So they're, to the nth degree.
They're tracking everything. And if they're tracking it, we can manipulate it to
your advantage. Absolutely.
Benefit.
Yeah, absolutely. So, if
fundability, #fundability.
It really is that simple.
Yeah. And the funny thing is we've been doing this actively. I've been studying it and implementing on my boutique business for 30 years, right? Mm-hmm. But in the last 10 years is where we've built the horsepower and got the data to support it, and now building the app. Yeah. The fascinating thing is we're still the only game in town that does any of this for borrowers, and it literally makes the biggest difference in the world.
Really
so
does. And if you know the tricks, if you know what the banks are doing, you can play the game. Again, if you're scamming them, they're going to figure that out. Yeah,
they'll know that.
Figure that out real quick. I'm not saying you're scamming them. You're playing the game. I'm smart. I'm going to show them all my cash flow. That's the answer. I'm not going to half my cash flow, Well,
because that disadvantages me and them.
On the application, you've got $22,000 worth of cash flow a month. We only see $7,000.
What? Yeah, somebody's lying.
Where is it?
Yeah, where is it?
Where is it?
And that where is it question takes you to manual review instead of automatic underwriting.
Don't want to go to manual review.
Nope.
Nobody survives manual review.
You'll never survive manual review.
Because here's the thing. Think about it this way. And I talk about the culture of automated decisioning to the regional and community banks. The tier 1 and 2s have taken care of it. But the regional banks, the tier 3 and 4s, when something hits an underwriter's desk, they, especially if it's like less than $100,000, if they lose a $100,000 loan, life goes on. But they also have this $1.5 million commercial real estate loan on their desk. They also have this $2 million, strip mall loan that's really weighing more heavily on them.
And is more profitable. And because remember, a $2 million loan, the time to go, it takes the same amount of time to underwrite $2 million as it does $100,000.
It really does.
No bueno. You're going to be so low priority
you're low priority, or I'm going to quickly say no to this to get back to this $2 million that I'm being screamed at because this has C-level attention.
Yeah.
Or branch manager attention. Your loan at $100,000 doesn't. So I may kick it out with some really bad terms that are acceptable to the bank, because higher terms and worse terms are always acceptable to the bank. Better terms, maybe not. And I'm not saying underwriters do this a ton, but there's that psychology of,
no, that's fine.
I shouldn't be doing this. I shouldn't be looking at this $100,000 loan because I've got this other stuff to deal with. And I talk about automated scoring to remove those loans from that person.
Yeah.
This underwriter is getting paid very good money to make really hard decisions about really expensive loans.
Yeah. Why waste time, energy, and resources on
these? If you can work with Merrill and stay in the guardrails of an automated decision, you're going to get more yeses than nos. I guarantee it. Because once it hits underwriting, anything can happen. Again, I'm not saying it's.
Can I quote you on that?
Yeah.
We're going to clip this out.
Anything can happen at that point.
Yeah.
You went from objective review to subjective review, even though you have the most unbiased professional team of underwriters. If you put 4 loans, let's say 5 loans in front of 5 underwriters, they're going to approve, let's say 3 out of the 5 loans. But when you ask them why they approve the 3 or why they decline the 2, you're going to get different answers.
Right.
And that's just human nature, right? Yeah. I have a bias towards DTI. I have a bias towards this. I have a bias towards that.
Their portfolio performs better given X, and they focus on X.
Yes, and they laser focus on it. Now, that doesn't mean if you put those same 5 applications through an automated system that you're going to get a different outcome. You could. 3 will be approved, 2 will be declined. Is it going to be the same 3 and the same 2?
Probably not. Maybe not.
One of them will be different.
Okay, this reminds me of the panel that you invited me to at like a FICO 18, and you were up there with a bunch of
pre-COVID, because that's for anything pre-COVID.
Yeah. It was pre-COVID, and he was leading this panel of these underwriters and VPs of banks. I won't name names or banks, but it kind of went off a little bit. It was a very narrow group of people who were in there. There are like 17 of us. And I remember that they were talking to each other about what they do to avoid underwriting $50,000 and $100,000. They're like, yeah, you give us your card. They're the decision maker. And they're like, I will have the decision maker give you a call. And literally in front of my eyeballs they would say that they would trash can the information because it wasn't worth their time in manual underwriting. Very much worth their time in automatic underwriting.
CU Insights, Credit Union Magazine, they ran a study that showed that profitability for a small business loan starts at $32,000. If you're manually underwriting a $32,000 loan, you're not making any money.
From the rate, term, and the cost of the
5 years. You're just making a dime. So $50,000, they're making what, $300? So you can only make these small loans profitable if you automate them. And the bank underwriters know it. They know this is a favor.
Yeah.
This $50,000 loan
We're doing you a solid.
is doing them a solid. Even look at it, and because think about it, if you knew in your business that a transaction is going to break even, you're not making a dime of, how excited are you for it? If you're making a batch of friendship, baguettes, let's say baguettes, and you're like, I'm going to spend the next hour making these baguettes, and it's going to cost me $30 to make, and I'm going to sell 10 baguettes for $3 a piece and break even. You're not doing it.
Yeah, that's a lot of work.
Time.
There's a lot of work.
And are you going to sell them for $2 and lose $10? No. No.
And that's why automatic. And what's funny is we send our people into banks, right, to start a relationship, and they will they'll start an application process and fill out the checking account information. And because they're highly fundable, it says they're starting the relationship. We want this to happen after 90 days. We think we're doing well. So many times they'll go into tier ones. They'll go in and be like, oh, this says you qualify, no inquiry for a $20,000 credit card. And they're like, let's do it. And then they fill out the application for the credit card. Of course, there's all the fundability triggers. And then they're like, it says you qualify up to $100,000 on a business line, but we have to do an inquiry. Do you want that? Yes. Gets a 50 and a 20 and walks out the door with a brand new banking relationship because you had the data when you're filling out the checking account information.
Yeah, they're doing a lot. They're opt-in boxes that you check on that DDA application, and they are doing a lot in the background. They're hunting for you.
Yeah, they're looking for whether or not they could trust you already with money with a brand new relationship.
And again, B of A has this, Huntington has this. They're instantly looking to see if they can fund you up to $10,000, just walking in the door, looking at a checking account instantly. Because it's the former overdraft product that they've been poo-pooed on by the regulators.
Yeah.
That now they're turning into just loans. You want a line of credit for $10,000.
Yeah.
And it's
and once we have an approval, we can rate our traffic patterns will incite higher and hig're approvals.
And it's like, it's the first one's free, right? Let's give them a small loan, see how they deal with it, to your point. And then if you're successful with that, you're successful with the next thing, you're successful with the next thing. Pretty soon you're sitting there where you really want to be.
Yeah.
Yeah.
I love David. Again, I don't want to keep you all day, even though I would, because I'm a greedy bastard, but thank you again so much. You helped my tribe. You helped me even shape. I showed him the scope document for our application yesterday.
Yeah.
We have so many positive things happening, and your intel, the NDAs, all of it have helped me build something that is going to be so valuable to not only the ones listening, but literally millions of people are going to be able to become fundable on their phone and do the things they need to do to make these intelligent decisions.
We've also connected him to some of our FICO score brain.
Got a brand new
connection. Yeah.
So more on this later.
Yeah.
It was serendipitous.
It really was. Sometimes you're just like, okay, this was meant to be.
Yeah.
But he started asking questions. I'm like, oh, here's the man that can answer those questions. Walked right in
and it happened to be a guy that I saw do a presentation at CreditCon like 3 weeks ago. And he and I had a conversation over a group of 200 people, the heads of 200 people. And we just kept this conversation going. And then he walks in and says, yeah, I'll be your FICO score guy. I'm like,
I think I know a lot of stuff. These guys actually see the soup being made, right?
Yeah.
So yeah, it's
brilliant.
Fascinating. I've had a good time.
Dude,
thanks for coming by.
It's always freaking magic, man. It's always magic. You guys, I love you. And we're bringing this live from FICO World 23.
And I'm going to give a shout out to Jessica and Sarah, members of his team.
They were here as me too.
Just magnificent.
They are. Yeah. They know they're
so sharp, man.
Sarah sharp. Sarah, when we're on Fundability Hackers, Sarah is one of the advisors who's usually there attending.
Sarah knows her stuff.
She's sharp. And we brought her back here to help us in our data analytics and be able to create a broader and more powerful base for our decisioning inside of our application. So we keep moving forward. Thank you so much, David.
Dude,
man, it's a pleasure. Always a blast. All right, you guys, be well. We will see you next time.
Thank you for listening to the Get Fundable podcast. Please leave comments because Meryl would love to read about your aha moments from this episode. And be sure to visit getfundable.com to read our blog, get important links, join our community, and much, much more, like ordering Merrill's tell-all book that is changing the world, The New F Word. And you gotta tell your friends about this podcast, because we want them to get fundable too.